Summer sun stagnation at the equity markets. Many of you know the old saying, sell in May and go away. So the idea that over the summer months, there's not much to be missed on the equity market. But is this really true? People usually forget the second part of this saying, which goes, and remember to be back in November. But again, the idea would be that you have to be invested between November and May, but over the summer months, there's usually not too much to be missed. Let's have a look at the data. And I just brought here a study of one of many that looks at the US equity market, the largest with the longest history. And what you see is here in the slide, two things actually. You have this line, which simply shows the probability that in a specific calendar month, the performance is positive. But what is even better to see, I guess, are the columns. The columns show you the average performance in this particular calendar month. And it's quite easy to see. You have the high bars in the period from autumn to May. But over the summer months, May to autumn, they oscillate around the zero line. So actually data seem to actually corroborate this fact. And this is visible over many markets. It's not just a factoid of the US market. In general, there's a statistically significant effect of weaker performance on equity markets over the summer months. Not necessarily this year. You know, we're already since end of May more than 8% in the plus on the US market. But on average, is this something that you can exploit for a personal gain? Should this guide your investments to make better performance if you just skip those months? And here I would warn you, if you look closer, you see that it's a fun fact, but look at the levels. In the good equity months, you have a performance of 1 to 1.5% on average per month, which is not bad. If you analyze this, quite a decent yearly performance. In the weak summer months, the monthly performance hovers around the zero line. Bear in mind, the difference between the good and the bad months is slightly above 1%. So think about it, 1%, that's your average daily fluctuation on the equity market. So it looks nice in the chart and it's significant, yeah, all granted, but if you just miss one day on the equity market, you might miss the same 1% performance that makes the difference between the good and the bad months here. So yeah, the effect is there, but it would not guide my investment decisions. It's not the thing that it will improve your performance over the long term. What's important for your long-term performance? You see it on the second slide. You will probably recognize it. There's a video on this in detail. The idea being that with underlying economy growing over the long term, a broad sample of global companies will increase in value over long term. That's what we have in the chart. The line is the value of the top couple hundred equities, companies globally. And you see a lot of fluctuations with recessions, crises, etc. But the value over all those fluctuations going up. Historical data, no guarantee this continues in the future, but over the last decades, 100 years, this proved out because with the economy growing, companies on average make more profit and become more valuable. So the idea would be, don't try to time a percentage here, percentage there, a month on the equity market. Make sure you're invested, well diversified in a broad sample of good companies. Easy to do, for instance, with an equity market fund who does the work for you, and then give it time to go up with the economy over time. That's something that we think is really important for your long-term financial profitability of the investment. What's also important is, of course, don't forget to follow us. We will keep you updated soon again. Until then, I wish you a nice summer.